Federal Reserve Chair Jerome Powell is signaling that the recent slowdown in U.S. hiring strengthens the case for interest rate cuts, rather than undermining it. Speaking after a softer-than-expected jobs report, Powell noted that payroll growth has cooled from last year's pace and that the labor market is no longer overheated, even as unemployment remains relatively low. Markets are interpreting his comments as confirmation that the Fed still aims to ease policy, with futures now pricing multiple cuts over the coming year, starting as soon as the next few meetings. For investors, the message is that the Fed is increasingly focused on the risk of keeping policy too tight for too long, especially as wage gains moderate and job openings decline. Lower rates would relieve pressure on rate-sensitive sectors like housing, small caps, and high-growth tech, while potentially weakening the dollar and supporting risk assets globally. But Powell also stressed that any move will remain data-dependent, and that the Fed needs greater confidence inflation is on a sustained path back to 2%. The next catalyst to watch, the upcoming monthly jobs report and core inflation data, which will heavily influence whether the Fed delivers its first rate cut or stays on hold.